and welcome. My name is Toby Shapshak, and today we are talking about Standard Bank's platform paper. This is the launch panel discussion, and I am joined by an esteemed panel of very smart people. Our conversation today is based on a thought leadership paper produced by Standard Bank titled Succeeding with Executing a Platform Strategy. The paper is co-authored by platform experts Sangeet Choudary and Standard Bank's Kent Murray. Platforms are the dominant organizing mechanism for firms, especially those participating in broader ecosystems. A business looking to gain competitive advantage needs to develop a strategy. This is as important today as a cloud business strategy was 10 years ago. However, successful platforms are the exception, and many efforts to build businesses based on platforms have failed to scale and benefit from the network effects that facilitate such platforms' growth. On their journey to becoming a platform business themselves, Standard Bank have learned some invaluable lessons that they will share with us today as we look to understanding the factors that lead to the success of the platform business. To delve deeper into the topic today, I'm joined by Chris Brown, who's been with Standard Bank for the last 18 years. He has worked in various senior leadership roles across various divisions, including leverage finance, wealth management, insurance, fiduciary services, specialized lending, and client solutions. Currently, Chris is the executive head of platforms, payments, and big tech partnerships for Standard Bank. Hello.
Hello, Toby. Thank you.
Thank you for joining us. I'm also joined by Kent Murray, who has a wealth of experience that spans over 20 years in the financial services industry. Currently, Kent heads up the platform domain in the group's client solutions team. Rafeda Hamilton is the head of payments for South Africa. I really like that title. Rafeda has 22 years of extensive experience in financial services, payments, and traversing the investment, corporate, and retail banking segments in the country. Welcome.
Thank you.
Andrew Mashanda is the Chief Executive of Stanbic Uganda. Hello, Andrew. And he has been with the Standard Bank Group since 2006 and until recently served as the Executive Director of Corporate Investing Banking in Nigeria for Stanbic IBTC Bank Nigeria. He has held several management positions and was most recently the Chief Executive of Standard Bank Malawi for 4 years prior to being seconded to Nigeria. And as it happens, we both worked together 20 years ago at a media company. Hello, Andrew.
Hello, Toby.
Nice to see you again. Lastly, joining us virtually, we have Sangeet Choudary, who is the founder of Platforming Labs and the best-selling author of Platform Revolution and Platform Scale. He has advised the leadership of more than 35 of the Fortune 500 firms and has been selected as a young global leader by the World Economic Forum. Sangeet's work on platforms has been selected by the Harvard Business Review as one of the top 10 ideas in strategy, alongside such great names as Michael Porter, Clayton Christensen, and others, and is one of the rare articles to have been featured thrice in the Harvard Business Review's top 10 must-read compilations. Hello, how are you, Sangeet?
Thank you. Pleasure to be here.
Thank you for joining us, everyone. And let's jump right in, shall we, Chris? Because reading your entry to the platform paper, you speak about the importance of striking that very delicate balance between being truly digital and truly human. How is Standard Bank able to do this, given its presence in so many diverse markets in Africa?
No, thank you, Toby. And I think, during COVID-19 pandemic, we have rediscovered the value of real human connections, be it with family, friends, colleagues, and communities. It is also reaffirmed that digital technology has this innate ability to bring us all together, to be more human connected, not less. Moreover, digitization has sparked this marked adjustment in power away from the corporates towards our clients, our stakeholders, and just society at large. With digital disruption impacting almost every industry, clients have come to expect this personalized service that can be accessed anywhere at any time via their preferred touchpoints. As digitization drives this convergence of industries across the globe, traditional financial services groups are contending with a wide range of new competitors. And at the same time, the blurring of the industry boundaries provides us with an opportunity to meet a wide array of clients' needs, deepen our customer relationships, and fulfill our purpose of driving Africa's growth and uplifting her people. At our group, Standard Bank, we continue to respond to our clients' needs and our employees and continue accelerating and implementing our future-ready strategy. One of our key focus areas within lowering our cost to serve is to find that right balance between being truly human and truly digital. I think to get this right, we need to future-proof our workforce with some hard skills, data science, programming, behavioral sciences. We believe that being truly human will remain a key engagement imperative. However, going forward, there has to be this shift away from this human interface behind the scenes in the back offices, because that often slows the service to our clients and acts as a bottleneck, because solutions have not been fully digitized. Therefore, enhancing our straight-through paperless processes is one of the key measures and one of our key focus areas. I think as banks evolve from traditional to being fully digital enabled and more diversified services organizations, we'll continue to see the value of offerings, leveraging more technology, and providing a better understanding of risk assessment of each of our clients. The end consumer will ultimately feel the impact and will be better equipped, and we will certainly be better equipped to deliver exceptional universal financial services solutions delivered in a truly digital and human way.
You had me at truly digital. I've been trying to do truly digital my whole life. I just keep having to stop for lunch. I mean, what I've heard you say, Chris, which is a few of the themes that have come through, is that you need to keep the client at the center, right? And you need to be tech ready. But you have to bring your teams along for the journey and make sure that their skills are enough to keep them future fit. But you also need to collaborate with others to increase your impact on the continent. Yeah. Well, as the Standard Bank nears its own goal, Kent, to be a platform business entirely by 2025, what are some of the learnings and things that you've picked up along the way that you can share with others?
Thanks, Toby. So we've made great progress on our journey to becoming a platform organization, and it's a journey. I don't think it's a destination. It takes a lot of effort and time to get there. At the heart of it, we remain committed to serving our clients, helping them meet their ever-expanding needs. We will therefore support our clients and offer services that go beyond traditional financial services. To achieve this, we've adopted a three-pronged approach. Firstly, we will embed financial service products like payments in other people's platforms. We'll then create a marketplace for our services and third-party services. And finally, we'll look to create specific platform ventures focusing on specific client needs and specific client segments. Although the journey will always be tough, we have found that there are several things that you can do to help drive the adoption of a platform business. Firstly, senior leadership is vital. Senior leadership buy-in determines not only the prioritization of the initiative and the funding awarded to it, but also the extent to which other stakeholders across the organization engage to support the success of that initiative. There are several ways to get buy-in from leaders. Firstly, framing the platform initiative within the overall goals and business strategy. It needs to be a core part of the broader strategy that we're trying to achieve. Platform initiatives also require a longer-term investment horizon. So it's key to de-risk the business case by deploying initial pilots into the market. Educate the executives and tailor your message to them. It needs to be personalized so that they can truly understand what it is you're trying to achieve. Next, you need to ensure the alignment on how to measure success of the platform initiative. Most platform businesses require significant upfront investment to mobilize the ecosystem. This investment often comes with a longer horizon as the business validates its initial use cases, builds critical mass, and starts to scale the platform venture via network effect. Ultimately, it will create and then share value amongst the various participants within the platform. This longer time horizon makes it difficult to define the right measures upfront. Financial metrics are easily understood by bankers and other financial service providers, but when a platform business is just getting started, it's difficult to measure value creation by financial metrics alone. These need to be complemented with non-financial metrics to support the platform growth. In addition, you need to create the right business architecture to support innovation at scale. Ideally, you're looking to enable distributed innovation with strategic coordination. By creating shared services, a set of standardized modular services that are reused as building blocks across many products, you can support this. The organization structure should also be agile and responsive. This can be done by creating small teams across the organization to operate independently as loosely coupled units with the level of central coordination. These small autonomous innovation teams are able to solve problems by being close to the customer, while also ensuring solutions are developed, are standardized and reusable by other parts of the business.
Indeed, and I mean it's crucial that management buys in, that the leadership is deeply involved, because it's not enough if you set all of these ambitions, but the leadership is not on board. They aren't investing in long-term goals and setting KPIs and milestones as the progress continues, and they aren't investing in the infrastructure or aren't willing to take risks. You've got to embrace all of these risk-taking behaviors, don't you?
No, 100%, Toby.
Indeed. Well, let's speak to you, Sangeet. I mean, theoretically, we do know what we need to do to win, but can you talk us through some of the real-life challenges and opportunities that are posed by these ecosystem-centric operations and this new way of doing partnerships?
Absolutely. So we heard Kent talk about a lot of the factors that are needed to succeed as a platform organization. What I want to frame those ideas within is the idea that fundamentally, when we talk about ecosystem-centric businesses, we are operating as part of a much larger ecosystem of connected entities, and that operating in that model requires fundamentally new mindsets. It requires fundamentally new trade-offs that need to be managed, and it requires fundamentally new ways of managing risk. So if I take a few examples over here, the first thing to think about is when you're in an ecosystem-centric business, you need to have a right to sit in the middle. What exactly gives you that right? Because you could say you want to be a platform organization and you want to create this single point of serving the entire ecosystem, but your partners may not really agree. They may want to be the platform organization themselves. So what gives you that right to sit in the middle? And we've seen many businesses face this challenge when they go down this path. Even Google, when it started Android, had a lot of problems getting Amazon and Samsung and others to follow its bidding. And eventually Google negotiated or out-negotiated them because it owned critical components like Google Maps, and that allowed it to negotiate power away from some of these organizations and sit in the middle of the ecosystem. So you need to think about what's your right to sit in the middle of the ecosystem when you're in such a business. The second thing to think about is how do you assess risk in a model when you are in the middle of an ecosystem? What are the types of audits that you need to have? What are the types of continuous metrics that you need to capture about different stakeholders and how they interact with you? How can you create a continuous due diligence mechanism implemented into your APIs so that you're constantly validating the right of every stakeholder to be part of your ecosystem while you ensure you are in a position to guarantee safety to all stakeholders? And the third thing to think about, with your right to sit in the middle and your ability to manage risk, is also how do you ensure that you incentivize all participants in the right way? And a lot of the challenges and opportunities are linked to incentives. When platforms extract too much value from their partners, the partners may build for some time, but they eventually move away. And there's always an opportunity for another platform to come in. And when they do not extract sufficiently, they end up becoming commoditized and they end up becoming a social service, and there's not enough value for the platform to continue growing. So you need to be very clear about how you manage those incentives as well.
Thank you, Sangeet. Andrew, let's just talk about what Sangeet's been talking about in terms of the context of all the different markets in Africa and what some of the challenges are and the opportunities of which you've experienced several key markets.
Thanks, Toby. Let me start off with opportunities. And I'll talk specifically about the East African region, which I'm most familiar with. East Africa remains arguably the most integrated region in Africa. We've seen the East African community having a vision of creating a very powerful and sustainable economic and political bloc that will drive GDP growth for the entire region. The population is young, it's entrepreneurial. We're talking about over 280 million people, of which 30% are in the urban areas, and the urbanization continues to grow. This young and entrepreneurial population is becoming increasingly technology savvy. We've also seen the creation of digital hubs by Google and Microsoft, and this has attracted pools of talent in the technology space into Kenya, and that talent is available for the region. We've also seen a marked increase in the intra-regional trade amongst the countries in East Africa. And we've also seen that in countries like Uganda and Kenya, foreign currency markets are fairly liberal. So the movement of foreign currency across borders is quite easy. We've also seen the availability of cloud infrastructure, which allows for scalability. I mean, if you look at the work that we've done in payments, that was referred to, I think, earlier by Chris. Only 5% of the opportunity can be serviced by current infrastructure today. But the massive opportunity which remains untapped and a platform business model can facilitate the creation of value is in the 95% that we are not able to capture today. And that's where I believe the real opportunities. The challenges remain largely logistical, whether it's physical or technology, connectivity. But we believe that a platform business would facilitate the exchange between the consumers and the producers, as mentioned earlier. Thank you.
It's a really good summation of the opportunities of this very active East Africa community. And what I'm pleased to hear is that there are more examples of opportunities than hindrances. That's a very good sign. Rufeda, Andrew mentioned transactions as one of the drivers for behavior in these different market regions. And we know that some of the world's best platforms have tried to make big plays in the payment space, but they've had different degrees of success. What role do you think payment services play in executing this very important platform strategy?
Thanks, Toby. Such a great question. And both Kent and Andrew have touched a little bit on payments. And I want to just take a step back, right? So if you peer into the cloud, I'm talking the digital ecosystem in the cloud, payments are not typically seen as a highly profitable payments platform service. In fact, we usually give them away. Don't panic, Chris. I think my point, and I sincerely believe that payments remain a critical success factor for any platform. They, Sangeet spoke a little bit to some of the Chinese or Asian and then American examples, but I would go so far as to say that payments remain this embedded plumbing within a platform that creates seamless customer experiences and engenders maximum customer retention with the opportunity for long-term customer value. Successful platforms, we've seen them, they start from a core product. It could be anything. It could be a ride-hailing service. It could be a messaging platform, an online auction house. But the trick to it is they quickly evolve it, adding content that keeps a client in that ecosystem for as long as possible, because the longer you're in there, the longer you are going to be valuable to the orchestrator of that platform. In China, for example, a huge market of mobile young digital natives, created the most powerful, competitive, and diverse marketplace platform led by the super apps, WeChat, Alipay. Sangeet's mentioned them. And the power of them, the likes of Facebook in the West have been observing with fascination, watching this evolution and trying to catch up, but still a long way to go. If you look at the Chinese market, therein lies the power of the payments experience. So the payment service creates this ultimate stickiness, platform stickiness that creates extra customer value. WeChat, Alipay embed a payments capability into the overall experience. It's so intuitive. There's a dedicated wallet combined with the seamless checkout experience, good dispute management. The end goal is it encourages the user in that ecosystem to leave value in that ecosystem for future use. In this way, an embedded payment becomes an indispensable component of any platform. Facebook, we know, tried to emulate it. Not very successfully. They looked at these Chinese super apps, tried to go one better, not just an embedded payment capability, but an embedded payments currency, Libra, and then DM. And in the end, it was overreach massively, in my view. And for many reasons, including regulator concern and scrutiny, it failed. But the logic of the platform embedded payment capability reigns supreme. Facebook will have to try and build again Meta and will have to get it right for the success of Meta, I would go so far as to say. The $64 question is how? I'd watch this space. Coming closer to home, in Standard Bank, we are, I believe, well-placed and have a natural advantage to leverage this aspect of platforms. We ought to be able to create that stickiness with embedded payment capability and this diverse range of financial products and services, as well as a broader marketplace of services and products that will be attractive to users in our ecosystem. The trick for us, I think, will be getting our wallet strategy right. How can you enable a wallet that seamlessly, smoothly is available for any and every payment interaction and allows a client coming into our ecosystem to leverage it and to store forms of data, diverse forms of data in our ecosystem easily?
Indeed. I mean, what strikes me is how we've evolved from a wallet being something leather in your pocket or your bag to being software on your phone, right?
Exactly.
I don't carry a wallet anymore. All my credit cards, all my loyalty cards are digitized, and that's just one of the first steps of the process. Sangeet, let's look at all of the great opportunities that Rafeda speaks about. Why do you believe that most platform organizations fail? What are some of the common pitfalls that you've identified? And what can organizations do to avoid those kinds of failures?
Yeah, that's a fascinating question because there's a lot of talk about how everybody wants to become the next platform, but you often see that the graveyard of failed platforms is much more highly populated than the few companies that have really been successful at unlocking massive value. Once you are successful, there are fewer limits to scale and value creation as a platform. But getting to that success, there are quite a few reasons or quite a few factors that come prior to that. One of the key things that we see platform businesses fail with is understanding the importance of balancing three very conflicting criteria. Or three very conflicting goals. You need to scale, but you also need commitment from the ecosystem. Scale is how big your ecosystem is. Commitment is how committed they are to you versus alternatives. And you need to profitably manage that ecosystem. You need to monetize in some way without reducing scale or commitment. And there are many examples that show why this is important. I mean, think of Uber entering ride-hailing, entering markets. It scales very rapidly, but there's no commitment. You have the same driver working across 3 different ride-hailing services, and that's why they continue to burn money 10 years after starting, and it ends up becoming a game of last man standing, who has more money to burn. It never reaches that profitable, sustainable model. So ensuring that you get to that scale versus commitment, this has especially been exposed this year with the cost of capital increasing. You saw during the pandemic, everybody wanted to put money into edtech platforms and not really accounting for the fact that once we went back to normal, people would stop consuming education entirely online. And now you suddenly see that those companies invested heavily in scale without any commitment. All of that demand elastically fell off. So managing this trade-off is critical, and platform companies actually have very different organizational units for managing scale versus managing commitment versus managing monetization, just because they're so much at odds with each other. The second thing I want to just call out over here, and this builds off an example that Rafaela just mentioned, Facebook launched Libra, and one of the reasons they failed was that there was a fundamental conflict of interest between an open standard like Libra and Facebook's ownership of a community like WhatsApp. People were concerned that while they promote the open standard Libra could push a WhatsApp wallet globally and make that the default wallet while the open standard and the currency was being pushed out there. And that was one of the main concerns when you have traditional companies move in this direction. You need to be clear about what's your business currently, and is there a conflict of interest with the new business that you're getting into? If you're a bank, is there a conflict of interest if you get into the housing search business? Or if you're a CPG company, is there a conflict of interest if you get into e-commerce? So understanding if there's a conflict of interest between your traditional business and the platform business is critical. Amazon is a great example of how that conflict of interest constantly frustrates merchants because Amazon keeps competing with them on the platform. And the final point, I'll just reiterate this. Platform businesses fail either because they are too open or because they are not open enough. There are very few who are able to open just about right to get external participation while also managing risks successfully. So these are my 3 key reasons why platform businesses fail today. And if you're going down this path, you need to really look out for these 3 things as you move forward.
I mean, what's fascinating to me is that collaboration seems to be the most important factor here. And while startups have the capacity to be nimble, it feels like the incumbents, the big banks, have the real advantage if they've built strong partnerships and credibility with banks. Like, I have my home loan with a bank. I don't have it with a startup. There's a level of trust. But I suppose trust is the key, and all of this can only happen when there is this kind of trust around them. Isn't that so, Kent? It's Standard Bank has built up a level of trust with its customers for decades, and that gives it the right to be at the center of the ecosystem and to build that platform ecosystem with your partners.
Agreed, Toby. And I think, if people ask the legitimacy of financial services firms playing in this space, it's around that trust that we've managed to get. And being a 160-year-old or 60-year young organization, we've got lots of trust with lots of partners and lots of consumers. So building a successful platform business is difficult. We've heard from Sangeet, it's rather the exception rather than the rule. So one of the key challenges in building a platform business is how do you build the communities on all sides of the platform? The so-called chicken and egg dilemma. And there's several strategies to address this, but all of them require an environment where parties feel safe and secure. Hence, the platform needs to build trust among all participants and between the participants and the platform itself. From our experience in the space, there are 3 key areas to focus on when building and then retaining trust, because you need to keep that trust as long as the platform continues to operate. So first of all, you need to think about how do you create an appropriate governance structure and managing any potential conflict of interest that may arise. Next, you need to think about how do you create an environment to facilitate the interactions and make sure that people trust that environment. Finally, how do you signal commitment to partners who are going to need to invest in this platform and support the innovation on the platform. So let's go into these in a little bit more detail on each of them. Platform firms need to establish fair governance. It needs to be seen as fair to all parties within the ecosystem. And they need to do this especially when they're managing their relationships with their partners. Clearly convey the rules of engagement, how people should behave on the platform, and then continue to educate your partners on that governance and the right type of behaviors that you want to see from them when they operate within the ecosystem. They must also ensure that they avoid conflicts of interest. Sangeet's given a couple of examples previously, and this is specifically important when the platform owner also acts as a provider on the platform. You know, other participants in that platform might think they might be disadvantaged if the platform owner all of a sudden starts changing some of the rules of the game for operating. To allay these fears of interest, to allay these fears of conflict of interest, the platform owner should at least give a commitment to the partners and other players on the platform that they won't compete with them for at least a minimum period of time. Platforms create value through enabling interactions and need to create an environment where both consumers and producers feel safe and confident that they can transact. There are several different mechanisms to do this, including the creation of a reputation system. We've seen that with Uber, we've seen it with Airbnb, and it's a very powerful tool to do that. Next, they need to create clear identity management and access controls to the platform. And finally, they'll look at also moderating that ecosystem participation. Some platforms even go a little bit further and provide insurance cover or extra protection to participants on the platform. Next, platforms that require partners like developers to come into your environment and commit resources to open innovation on the platform. You need to build something called innovation trust. Platforms can help build this innovation trust by, first of all, signaling their commitment to the long-term investment within that specific platform. Next, they could also think about setting up an application development fund, aim at rewarding developers who build apps on the platform. And finally, you could even think about inviting partners to participate in the upside and benefits that are generated from the platform. For me, I think it's key, and the bottom line is that you need to properly curate and govern a platform to build trust and ensure its long-term viability.
Indeed, trust is the center of all of it, isn't it?
Yeah, it's the underlying foundation that makes sure that people feel comfortable that there's a predictable environment in which they can operate.
Indeed. Rufeda, listening to that, what are some of the challenges to creating this trust relationship in this kind of ecosystem environment?
So I love the framework that Kent has outlined. You know, it's so solid for and guiding. In my world, or our world of payments, there's a special sort of trust, and I will take nothing away from the trust that we've engendered as a bank for 160 years of our history, because that's just something that is innate to a bank. But when you look at a payment processing capability, it's there's a certain form of reliability. There's an expectation of a lack of risk or no introduction of risk into it that becomes our bread and butter. You can't get that wrong. So in a platform ecosystem, if we offer payments capability, embedded payments capability, and if we offer a wallet, it must offer a sense of reliability that is indisputable. So it will do what we expect it to do time after time, and it will do it correctly. Embedded payments on any platform, particularly ours, must be so easy and reliable so as to be invisible, native, intuitive, intrinsic, because you want to engender a sense that it works every time. I don't have to worry, and I can trust my ecosystem orchestrator that is a key feature of that capability. If we achieve this, I would call it the creation of this virtuous circle. We build this network effect that creates trust in the client who's in that ecosystem and will be comfortable enough and confident enough to leave value to come back later for future use. And it creates confidence in a merchant base who wants to bring their market and market their services in this ecosystem, because there's an attracted, trusted client base that they can tap into. This diversity of services, this network effect, in turn then creates and attracts more clients into this ecosystem. All sounds very easy. I wish it was, or everybody would be doing it today and we would have all gotten it 100% right. But it's not. We have to, and I think we have a good opportunity and an advantage in that we can translate this 160-year strong reputation, the expertise we have in the bank. I'm sitting with some of the best in the business, and turn this into a virtual world that shows us that we can, and shows our clients that we can deliver seamless reliability across Africa better than anyone else. So I'm very pleased and excited to be part of that journey, and I'm very confident we're going to achieve the 2025 strategy that we've set out on. That said, I would not be a banker if I didn't highlight the risk here. If we don't get on this quickly, the consequences are that we will not be competing in this environment. The dominance of the Chinese platforms have already demonstrated the ability to embed a payments capability in their platform. The financial services partners in that ecosystem are reeling, scrambling, trying to get back on that journey, but they literally passengers on a train, and they are providers in someone else's platform. So we don't want that. Look at what, Ant Financial is in the Alipay platform. So I feel very confident that the bank strategy is right, is purposeful, and will avoid us falling into that sort of death knell trap.
So it's a very interesting thing that's happening in the world at large, which is the shift of technology power, especially in social media, from Silicon Valley to China. TikTok is growing so fast, the Chinese super apps that everyone's mentioned, and the services embedded in them, especially payments. But Chris, you can't just apply technology. I mean, it's clear that this platform business is you have to be tech savvy and tech ready, but you can't just throw tech at the problem. You need to create the right environment for those kinds of technology-driven solutions to be fertile.
No, absolutely, Toby. And I think, when we think of technologies of today, they've got this immense transformational power. But deploying technology alone is not going to really be sufficient to generate any value. It needs to be coupled and really applied to solving real-world problems in business, in social and environmental areas. I think with the true business value being derived from services and business model innovation is where it lies. I think technology may not be the primary driver of value, but it's certainly a key amplifier which creates the scale and the network effect that Sangeet mentioned a little bit earlier. I think so when we think of platform organizations, they still need to develop their technological readiness and scalability, but really need to focus on a couple of key things. I think the first one is the data strategy and how does that ensure interoperability, both internally and externally. The second is this having an infrastructure that can scale. And lastly, the ability to manage your technology risk. So I think when we think about it, if we look at data, we all know data is said to be the oil of the platform economy, and it's one of the primary sources of value creation in a platform business. In most traditional organizations, data acquisition is almost incidental to the existing business processes that you follow, MR, data, etc. But at platform firms, they certainly, it needs to be a lot more strategically planned, determined by the business goals and led by business. I think this requires a cohesive data strategy, and a structured roadmap deliberately to be implemented, which then can help unlock some of the business value in several ways. The creation of data-driven products and services, different types of business models, differentiating our offerings to our consumers, our producers and partners, creating and delivering a truly, personalized experience. And then, obviously, the analytics to generate the business insights, which then inform your strategy as you move along. I think organizations need to create this interoperability with other platforms and partners. And, Sangeet spoke a lot about this earlier. The use of this common open standard is so important to achieve this. APIs, crucial, from external APIs, but also just, not forgetting your internal APIs and creating that interoperability internally across your systems. I think as platforms reach critical mass, they start to scale in a non-linear way. And, your typical J curve. This needs an operating model and scalable infrastructure that's going to support that growth. This may be achieved, I think, by employing all these microservices-based architecture, which loosely couple some of the modularity, which enables us to target modifications to be made at scale without increasing the complexity of the overall system, which is so key. I think accessing cloud capability naturally can further enhance the platform scalability. So I think, lastly, if we just move back to the technology risk side, I think data privacy and cyber security are key to creating a trusted environment. Organizations need to clearly define and enforce a data security policy. I think this needs to be carefully balanced and trade-off between obviously achieving your business goals, but balancing it off against your privacy concerns as well. I think in open ecosystems, cybersecurity becomes increasingly challenging as you are dependent on so many participants in the ecosystem. So organizations need to set up the appropriate cybersecurity capabilities and defense to make sure that their data security and regulatory compliance is top of mind. I think from a cybersecurity should be part of a core part of your partner due diligence and must be reviewed ongoing and periodically through that relationship.
I mean, it's a very complex checklist of things you need to know. Who would have thought APIs, microservices, cybersecurity? These are phrases that didn't exist a little while ago. So, Andrew, we've heard from Chris about the importance of being tech ready and the environment for tech readiness, but it's just as important to understand the regulatory framework in Africa, isn't it?
Absolutely, Toby. I think if you look at our regulations across all the markets, one thing that you realize immediately is that these regulations were designed for an industrial era competitive environment and for command and control systems for each of the jurisdictions. They were never designed to create that seamless cross-border interaction between the jurisdictions. But I think as we continue to talk to the regulators, you also start understanding certain themes that are emerging. One, obviously, being data sovereignty. Every one of the regulators obsesses about owning and protecting their own data. They're also worried about consumer protection as one of the themes that are coming through quite strongly. And I mean, we continuously look at the region as one economic area, so we continue to engage the regulators about harmonization of regulations across the entire East Africa region. But there's clearly a need for us to continue to engage the regulators and continue to sell the benefits. More often than not, we engage our regulators in a more antagonistic way or responding to certain regulations, but we also need to engage them about growing the market and creating an environment where platform businesses can thrive. Thank you.
You had me at harmonizing the regulators. I have one final question for you, Sangeet. I think having done this for several years now, we can finally call this a series that you've been doing with Standard Bank, and we hope there will be more. Just as reflection, what are some of the key shifts you've observed in the African landscape since the last paper was published in 2020? Are you encouraged by the progress that you've seen in the country and the continent?
Yeah, absolutely. I think Africa continues to be the next frontier for the platform economy, and there the story of why Africa is ripe for the platform economy has been widely touted. I mean, there's a huge untapped potential in the service economy in Africa, which can be organized very effectively through platforms. There's a large potential for financial inclusion. There's a large potential for getting value created by just getting to digital identity. So one of the things that we've seen in other markets, which is now starting to happen in Africa, is just the idea that if you want to move down this path of the platform economy, you'll have to think about what role governments play and what role the private sector plays. We've seen different rates of evolution in different markets. Arguably, you could say that in developed markets, governments had already figured out identity and payments way before we thought about platforms. And when platforms came up, they digitized it in the US, in Europe, etc. On the other hand, in countries like China, governments didn't ever figure that out well, but the big platforms sorted out payments in a really big way, in a way that banks never could, and that created the infrastructure for the platform economy. What's probably closer home to Africa is what's happened in India and Brazil over the last 3 to 4 years, where with the rise of unified payments, we've seen the part of the economy which could not be reached through traditional digital services or even through traditional government services suddenly now getting onboarded onto both sides together, and through that getting onto the platform economy. The corner store on the street that just had access to an SMS-based phone now can accept digital payments. And so that's really where I see the potential for Africa's platform economy, and a lot of those parts, the moving parts that need to move together to make that happen, have started happening in Africa. So that's certainly changed over the last couple of years. So going back to some of the points that Rufeda mentioned as well, payments and getting payments right will be key. And to get payments right in a fragmented regulatory landscape like the African continent, you can't do that just through private sector capabilities. You have to do it through collaboration with the public sector. Having said all of that, I'd say that 2022 is a really interesting time to start betting on Africa, because we've oversold the platform story in other parts of the world. We've seen how investments have played out when the cost of capital was low. Now the cost of capital is high, and capital and cash is seeking high growth markets where you can actually continue to see the growth that justifies the risk, whereas in a lot of other markets that growth now seems to have leveled off. And I believe that Africa continues to pose or provide that opportunity for really high growth in a high cost of capital environment. And so that's why I would remain bullish for Africa over the next decade or so.
Well, that's a really optimistic perspective. I'm very glad to hear that. I'm also very optimistic and bullish about Africa, so pleased to hear that from you. Sangeet, thank you very much for joining us, and thank you to everyone else, Chris, Rufeda, Andrew, Kent. I think it's been a really fascinating conversation about the primacy of platforms and all of the things that go into it, the trust, the payments, the understanding of the regulatory environment, the getting the tech space ready, and the fundamental reason that all of this works is that there is a base of trust. So thank you very much today for joining us for this video presentation of Standard Bank's platform paper discussion. You can read more about it in the links below. Thanks again, and stay well.